Good morning, and welcome to our 2020 Tax Update webinar. This year has brought about so many uncertainties with the pandemic, and no doubt this year is a year like no other. Especially now, we've wanted to communicate to you, our clients and friends, about pertinent tax information that may help you or your business. Please enjoy the webinar and feel free to ask questions during the webinar. We have, through the online chat system, we have people from the tax department ready to answer questions. And with that, I'll introduce Kurt Kuchenbrod with our Tax Advisory Department as our presenter.
Thank you, Christy, and welcome everyone. I am Kurt Kuchenbrod, CPA with Scott & Company's Tax and Advisory Services, and it's my pleasure to bring you a 2020 tax update. And I think we can all agree that 2020 has been a hectic year, to say the least, and brought about many changes as far as how we live our lives, and it's just an unprecedented time. So my goal for today is to kind of address some of the tax and accounting implications from the various laws passed in response to the COVID-19 pandemic. And I do think it's very important to note that each one of these laws, legislations are very detailed and have their own twists and turns. And in a 1-hour webinar, it's just going to be impossible to address every little detail for every possible scenario. So what I want to do today is give you a good idea, a good summary of the issues that we think are going to be relevant to a broad base of our clients, and give you the knowledge to know what questions to ask, and again to address your individual scenarios appropriately. We're going to go over the Families First Coronavirus Response Act, the CARES Act. We're going to have a detailed look at the Paycheck Protection Program loans, and briefly discuss any tax planning opportunities that these changes may present. So moving forward, we will get started with the Families First Coronavirus Response Act. So the Families First Coronavirus Response Act was signed into law on March 18th of 2020. It was the first legislation signed into law in response to the coronavirus pandemic. And if you recall, it extended various federal income tax filing deadlines and tax payment due dates. And it also established 2 refundable payroll tax credits, in the paid sick leave credit and also the paid family leave credit. So those are going to be the 2 main points that we discuss related to the Families First Coronavirus Response Act, being the payroll tax credits, since we are still dealing with the implications of that. So the first is the paid sick leave credit. Eligible employers must provide employees with paid sick leave related to COVID-19 if certain conditions are met. And this is going to be for payroll effective April 1st of 2020, all the way to year end to December 31st, 2020. So it's important to note that where this all began in April. Now, especially that we're seeing another spike in cases, it's very possible that this might not have been relevant to you earlier in the year. However, you could run across some instances where it will be relevant for the third or fourth quarter of 2020. Now, an eligible employer is an employer that has less than 500 employees, and an eligible employee fall into one of two categories, being the first being employees who are sick, and the second is employees who are caring for someone else. So the eligible employees who are sick are meet one of the following three criteria. They are subject to a quarantine or isolation order. They're advised by a healthcare provider to self-quarantine, or they're experiencing symptoms and seeking a medical diagnosis. And then the criteria for employees caring for others would be caring for an individual that are under quarantine or an isolation order, are caring for a dependent child of the employee because the school or place of care is closed due to COVID-19, or caring for someone experiencing a similar situation specified by the Secretary of Health. All right, the amount of the credit is based on required pay. So for employees who are sick, for full-time employees, the required pay is their regular rate of pay up to $511 per day, up to a total of 80 hours. So generally, a full-time employee is entitled to, again, their regular rate of pay up to $511 per day for 2 weeks. Now, part-time employees, their regular rate of pay is based on average hours worked over a 2-week period based on the previous 6 months. And with that, you may use expected hours if the employee hasn't worked for your business, worked for your company for the entire 6-month period. Employees caring for others, the required pay for that criteria is 2/3 the regular rate of pay up to $200 a day, again up to 80 hours or 2 weeks. And the part-time employee, the part-time regular rate of pay is the same. It's based on the average hours worked over a 2-week period based on the previous 6 months. And again, you may use expected hours if employees did not work over that entire 6-month period preceding when they qualify for the paid sick leave credit. A few other considerations to be aware of is when applying this credit, the qualified sick leave wages are not subject to the employer portion of Social Security tax. So that's a 6.2% the employer's Social Security tax is essentially the 6.2% of that qualified pay. So that is one tax that the employer doesn't have to pay on those qualified wages. The credit includes an amount based on cost to maintain health coverage for the employee during the paid sick leave. And so the employer's cost of maintaining an employee's health insurance coverage, that actually also factors into the credit amount. So on top of the employee's wages, you also get to factor in the amount paid to maintain their health insurance coverage. on the employer side, and also the employee side, if they take a payroll deduction to pay for their portion, that is obviously factored in as well. Accounting for this credit, the credit would be claimed as the credit claim is included in gross income, and then the wages and related expenses are treated as normal. And come tax time, you'll report the wages, and we just back out the credit amount, similar to the work opportunity tax credit, if anyone's familiar with that. So, and also one more factor into the credit amount is also the employer portion of Medicare taxes paid on the qualified leave wages. That's going to be also included in the eligible credit amount. Now, the second credit, the payroll tax credit, is the paid family leave credit, and you're going to see a lot of similarities between these two credits, but they're designed to work in conjunction with one another, which we'll get into in a little bit. So you can see that the paid family leave credit, the required pay is going to be 2/3 of the employee's regular rate of pay, up to $200 a day for up to 10 weeks. So you see that's going to be the same as the paid sick leave credit for employees caring for someone else. And then also the regular rate of pay calculations are identical to the paid sick leave credit. Now, to be eligible for this credit, an eligible employee is an employee who is unable to work due to a need to care for a child under the age of 18 due to school or child care closures. Now, there is a small business exemption, so any business with fewer than 50 employees are not required to offer the paid family leave, and the exemption would be based on the fact that if providing the benefit would jeopardize the business's ability to continue operations, then the paid family leave is not going to be required. But any other business with with 50 employees up to that 500 employee mark, the paid family leave is going to be required. Other considerations: paid family leave wages are, again, not subject to the employer portion of Social Security taxes, and that's essentially 6.2%. Employers may choose to treat the first 10 days of leave as unpaid. And again, this is going to be where working with the paid sick leave credit, which was only eligible for 10 days, this is presuming an employee takes that paid sick leave credit on those first 10 days, and then can, if they're still dealing with COVID-19, if they're still dealing with that, they can jump into the paid family leave credit as well after those 10 days for up to 10 weeks. So one important thing to note is if a school has an option for in-person classes, the employee will not qualify. And to go back, the qualifying child must be a son or daughter of the taxpayer, or basically just a dependent of the taxpayer. So if if a grandparent takes leave to watch a grandchild whose parents might need to work and can't necessarily take the time off, that does not qualify. So again, it needs to be a a son or daughter, a child, or basically a dependent of the taxpayer to qualify for the paid family leave credit. So aunts and uncles can't take time off to watch a niece or nephew and qualify for the paid family leave. Again, this credit also includes additional amounts based on cost to maintain health insurance coverage for the employee during the paid sick leave period. And again, the credit claimed is included in gross income, and then wages and related expenses are treated as normal. So you see a lot of similarities between the paid sick leave credit and the paid family leave credit, and of course a lot of it's treated the same way, just for different scenarios. So we're seeing a total benefit period of 12 weeks for affected employees. Now, claiming the payroll tax credits. So they were, again, two separate but related tax credits for the qualified sick leave and qualified family leave wages. They're going to be claimed on your quarterly payroll tax filings, your Form 941, and may be applied if you factor in the credit beforehand. You can reduce your required payroll deposit. And when you file your 941, if there's not enough employer payroll taxes to offset based on the credit, you can apply for the advance refund requested on Form 7200. And again, that's a request of that credit refund in advance, so you don't have to wait for the quarterly filings if there's not enough tax to offset via these two payroll tax credits. Now we've addressed businesses. Now it's important to note that similar tax credits are also going to be available for the self-employed. So there's going to be an equivalent paid sick leave credit and a paid family leave credit available for Schedule C filers or general partners with the self-employment earnings, so partners and partnerships. And the criteria is going to be the exact same, and the only difference is going to be the credit's going to be claimed on the 2020 individual tax return. So it's not, since unless the Schedule C filer has qualifying wages via payroll, but for the owners, the self-employed, the business owners themselves would qualify, again, would report this tax credit, claim the tax credit on their 2020 individual tax return. And that will be, that amount is going to be the average daily self-employment wages divided by 200, because again, if a self-employed individual qualifies for the paid sick leave credit, they still only have the 10 days, 10 eligible days to qualify for the regular wages up to the $511, and again, after that 10-day, 2-week periods up, if they qualify for the paid family leave credit, it's going to be again the lesser of the average daily self-employment wages or the $200 a day. So so just be aware, if that's relevant, that the self-employed self-employed individuals will not miss out on these credits since you know, again, they'll get to claim it on their individual tax return. So again, the self-employed individuals limited to the lesser of $511 per day for their own illness, or $200 a day if caring for others, or 100% of the daily self-employment wages, or 67% of the average daily self-employment income if caring for others, for a maximum of 10 sick days. The qualified family leave credit, again, limited to the lesser of the 2/3 of average daily self-employment income, or the $200 a day, up to a maximum of 10 weeks. So now we'll discuss a little about the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. And this was signed into law on March 25th of 2020. And here this addressed many of the more popular programs that you kind of hear a little more often, that are a little more relevant to a broader base here. So we're going to address the employee retention credit, items that affect business entities as well as individuals, the economic injury disaster loan, and of course the Paycheck Protection Program. So first, with the CARES Act, as I'm sure everybody is aware of, the stimulus, the recovery rebate that individuals received, and it was the recovery rebate is actually an advanced refund of a 2020 tax credit, and it was $1,200 for individuals and $500 for qualifying children. So it was definitely a good, substantial help for those that qualify and those that need it. And it was based on whether it was based on either your 2018 tax return for individuals, or if or 2019 if 2018 hadn't been filed, or excuse me, it was based on your 2019 individual income tax return, or if 2019 hadn't been filed, it was based on your 2018 adjusted gross income. So that amount was phased out for single filers with adjusted gross income between $75,000 to $99,000 for heads of household. The credit was phased out beginning at $112,500 all the way up to a full phase out at $148,500. And married filing joint, the credit was phased out between $150,000 and $198,000. All right, again, it was based on, the rebate was based on your adjusted gross income from either 2018 or 2019. If the credit was limited based on 2018 or 2019's tax information, but you otherwise qualify for it in 2020 based on your 2020 adjusted gross income, the difference will be claimed on the 2020 tax return, as so you'll be able to get the difference. So if the credit was received based on your prior year adjusted gross income, but would otherwise not qualify based on your 2020 adjusted gross income, you don't have to pay that back. So for instance, if you filed in 2019 and you're married filing joint, and say you have $200,000 of adjusted gross income, you didn't qualify for the recovery rebate. However, if you're a business owner and were affected by COVID and you're experiencing a down year as far as income goes for 2020, the fact that you didn't receive the recovery rebate in that first in the first round, you're going to be able to claim that if you qualify based on your 2020 adjusted gross income. And and on the flip side, if in 2019 you qualified based on 2019 adjusted gross income, and 2020 has been a great year, and based on 2020 you don't qualify, you don't have to pay that back. You don't. So again, if you qualify in 2020 but not in 2019, you'll get to claim it in on the 2020 tax return. However, if you qualified in 2019 but are having a great year and don't qualify based on 2020 numbers, again, that's okay. You don't have to you won't have to refund or pay that rebate back. All right, next we'll discuss the employee retention credit. So the employee retention credit is a refundable payroll tax credit for retaining employees and continuing to compensate them. And this is based on qualified wages from March 13th of 2020 all the way through December 31st, 2020. The credit is equal to 50% of the qualified wages up to $10,000 per employee, and the maximum credit of $5,000 per employee in 2020. And eligibility for this tax credit, this payroll tax credit, is going to be based on a business suspension condition or a gross receipts condition. And this last point here is very important. You're not eligible for the employee retention credit if a PPP loan was received unless the PPP funds were repaid by March 18th of 2020. All right, the two conditions that to qualify for the employee retention credit are the business suspension condition, so a full or partial suspension of operations due to a government order, or a gross receipts condition, meaning a significant decline in gross receipts. So this condition's met starting in the quarter where gross receipts were less than 50% of the gross receipts in the same quarter of 2019. And then that period ends in the quarter where your gross receipts reach 80% of gross receipts of the same quarter. So, let's assume there was a heavy COVID impact in April of 2020 in a business. So we're starting in the second quarter, and we look back at April 2019 and notice that gross receipts have fallen below the 50% of the same quarter last year. That if you continue to pay your employees, that's the applicable wages are going to be, we're going to start in April for that second quarter, and it's going to last up until, again, the quarter where your gross receipts reach 80% of the gross receipts for the same quarter of 2019. All right, some business considerations with the CARES Act. we're going to address a few of these in a little more detail when we discuss some tax planning opportunities, but perhaps the biggest change here we're seeing is with the net operating losses. So the Tax Cuts and Jobs Act limited NOL's net operating losses arising in 2018 through 2020. So what the Tax Cuts and Jobs Act did, where you could used to carry a net operating loss back, that the Tax Cuts and Jobs Act suspended that and disallowed a carryback of the loss, and instead you just carry it forward to the next year indefinitely. This provision was suspended by the CARES Act. So now you're able to, for business losses arising in tax years after December 31st, 2017, so 2018 through 2020, you're allowed to take those net operating losses and carry them back 5 years to, hopefully claim a refund based on the NOL carryback, instead of having to wait until the next year to apply that loss. So that's going to be very important in planning, and if businesses are struggling, to be able to get a little cash flow by carrying losses back. There's a business interest limitation. Again, the Tax Cuts and Jobs Act limited the business interest deduction to 30% of adjusted taxable income. Now the CARES Act relaxes that limitation to 50%. I'm not going to spend too much time on this because it doesn't apply to businesses with average gross receipts less than 25 million. But if your business falls into that category, then that is something to be aware of. Business loss limitations, again, they're suspended for 2018 through 2020. And also included in the act was a technical correction for qualified improvement property. And this was for commercial real estate. If say you put an HVAC unit into a commercial rental property, it used to be classified as 39-year property. It was subject to, or was eligible for 100% bonus depreciation. However, it did not qualify for Section 179. So, excuse me, I got that backwards. That's they qualified for Section 179, but not 100% bonus depreciation. The bonus depreciation is only for property with less than a 20-year life. So anybody, say again, we go back to this HVAC example on a commercial rental, you are limited to take in Section 179, which is limited to your business income. Now you're actually able to, again, take 100% bonus depreciation regardless of the business income. Again, was 39-year property. Now it's a technical correction. Shows it as a 15-year property and is eligible for 100% bonus depreciation regardless of business income. Some individual considerations. We talked about the recovery rebates. Also, they've put an above the line deduction up to a charitable contribution of up to $300 is allowed for taxpayers, not itemizing their deductions, therefore not claiming the general charitable contribution deduction. So everyone will be entitled to a $300 above the line deduction for charitable contributions, assuming that they were actually given. A few points on retirement plans. There's been early distributions up to $100,000 taken because of COVID-19. If you're affected by COVID-19, is exempt from the 10% early withdrawal penalty. And I think it's important to note that for a 401k, your plan has to adopt this provision. So it would be important to check with the plan administrator whether this is applicable if needed. And then also your required minimum distribution, those requirements are temporarily suspended. And of course, as we saw, expanded unemployment benefits for employees that were laid off or furloughed during the pandemic. All right, another major provision in the CARES Act was the economic injury disaster loans. The SBA economic injury disaster loans provided funds to small businesses in disaster areas, which COVID-19 pretty much qualifies everybody. Sole proprietors, independent contractors, and companies with fewer than 500 employees and less an ineligible business, they all qualified to apply for this loan. The loan is limited to $150,000, and as I'm sure most are aware, there was a grant portion when you initially applied for the economic injury disaster loan. Grants of up to $10,000 for applications submitted before July of 2020 were actually they're grants. They're you don't have to pay them back. They're not a loan, and that was based on $1,000 per employee up to 10 employees. So when we get into the PPP loans, it's important to know that there is coordination between the EIDL grant portion and the PPP for loan forgiveness, which we'll discuss here in a little while. So the economic injury disaster loan must be used for qualified purposes, which includes fixed debts, the paying of fixed debts, payroll, accounts payable, and other bills which could not have been paid by the business without these funds. You can use the economic injury disaster loan for lost sales or lost profits. You can't use it as a debt refinance or expansion of your operations. Also, can't be used for the same expenses covered by the PPP loan. So I think those are important to note if you receive the economic injury disaster loan, what you can use the funds for and what you're not supposed to use them for. And I think it's very important to note that documentation is key when you're using these government funds for qualified uses. It's generally a good idea to document everything and have your ducks in a row in case you're ever asked to provide proof of what you spent the funds on. The EIDL terms, the loan was intended to help businesses with working capital. The first loan payment is deferred for up to a year. The interest rates for the loan is 3.75% for for-profit business and nonprofit entities. The interest rates only 2.75%. Loans in excess of $25,000 require collateral, and for loans greater than $200,000, a personal guarantee is required. So again, and our record retention is going to be important here. All right, so now we are going to get into the Paycheck Protection Program. As I'm sure, again, everybody is familiar with, this has been the major source of continued legislation, and just I feel like a vast majority of our clients have received the Paycheck Protection loans. So this is probably the most important aspect of the webinar. I think that those are going to be most relevant to most of our clients. And the Paycheck Protection Program provided small businesses with the resources needed to maintain payroll. The eligible recipients must have been in business on February 15th of 2020, and the deadline to apply for funding was August 8th of 2020. That being said, further legislation is anticipated now that the election is over, and we're in a kind of lame duck period here. Hopefully this is addressed sooner than later, but there's really no telling. But we are anticipating further legislation, perhaps a Paycheck Protection Program, a second round of funding, or just kind of at the very least addressing some questions that still remain. So the forgiveness of the Paycheck Protection Program loan is based on the extent that funds are used for qualified payroll costs over the covered period. All right, so the funding, the PPP loan funding, the amount was equal to 2.5 times the average monthly payroll costs of the previous 12 months. So generally, we used the 2019 payroll when, especially when the first round went out. So we figured that average monthly payroll costs, and again, the application was based on that amount. The payroll costs include salaries and wages for a maximum compensation of $100,000 annualized. Employer paid benefits, including health insurance benefits and retirement contributions, counts towards the payroll costs. Employer paid state and local taxes assessed on the compensation, and also net earnings from self-employment income for independent contractors or self-employed individuals filing on the Schedule C of their individual tax return. Alternative calculations for seasonal or new businesses are available. Again, the PPP loan is limited to allowable uses when factoring in the forgiveness. So the funds, the PPP funds, must be used for qualifying payroll costs, mortgage interest, rent, utilities, and interest on other debts that existed early in the year. And not allowable uses would be, again, employee compensation in excess of $100,000 prorated, Social Security and Medicare taxes and federal income tax withheld, that does not qualify. Qualified sick leave wages and qualified family leave wages, as we discussed earlier, can't get that double benefit. So if you receive that, either one of those two credits, that the qualified compensation for those two credits do not count for PPP loan purposes. All right, PPP loan forgiveness. We're starting to see a lot of the banks and lenders are starting to send clients reminders on forgiveness, and this is what we've been dealing a lot with recently. Is, you know, now that the funds were received, your covered period has ended, or all the funds have been used. Now it's time for forgiveness. So what does all of this entail? So the amount forgiven is going to be based on the qualified payroll costs and the covered period. Your qualified payroll costs must make up at least 60% of the requested forgiveness amount. And again, we're going to look at the covered period for which is the extent of time that the qualifying expenses must have been used. Let's see. So the forgiveness application must be submitted within 10 months of the end of the covered period. And if you got your PPP loan, you know, within that the first round of funding, you had an 8-week covered period. However, when we looked at the let's see, with the Paycheck Protection Program Flexibility Act of 2020, which was signed into law on June 5th, it allowed more favorable terms for these the PPP loans. So instead of dealing with a covered period of 8 weeks, now we have 24 weeks to spend the funds on the qualified purposes. And there's various other changes came with the Paycheck Protection Program Flexibility Act of 2020, all of which are included in the facts as given here. So again, now that the funds have been spent, your covered period may be up. Now it's time to apply for forgiveness. So there's going to be one of 3 forms to use to submit to determine the forgiveness amount. And the form 3508 is you know, your standard for you know, businesses that may have you know, full-time employee equivalent, maybe employees or wages have decreased since the beginning of the covered period. Some various calculations need to be made, and that's going to be on Form 3508. Form 3508EZ is going to be helpful for your self-employed, Schedule C filers, independent contractors. And then Form 3508S is a simplified form for businesses that received $50,000 or less than $50,000 of PPP funds. And it's this less calculations involved, a simplified version of the 3508, again, for businesses that received less than $50,000 in funds. So other documentation will be required to submit to the lender, and that's going to include your payroll reports for the covered period, any FTE, full-time employee equivalent, reduction calculation, and rent, mortgage, utility receipts that make up that other 40% of qualifying costs. You're going to need to substantiate that those, if it's for rent, that your rental agreement was in place in February of 2020, and you know, again, you know, liabilities, rent, utilities, mortgage that was that was in place in before the COVID-19 pandemic. All right, so forgiveness limitations. The forgiven amount will be reduced if 60% of the PPP loan is not used for qualifying payroll costs. If your average number of full-time equivalent employees during the covered period is less than the average number of full-time equivalent employees per month based on the period February 15th, 2019 through June 30th, of 2019, or the January, if that's not applicable, you can use the period January 1st, 2020 through February 29th, 2020. And again, we're comparing pre-COVID employment versus employment during the pandemic, because again, the purpose of the PPP loan was to maintain your payroll and pay your employees and make sure that the effect of COVID on the employees is limited by keeping their wages essentially the same. A reduction in FTE employees will not reduce forgiveness if your former employees or similarly qualified employees cannot be rehired, or businesses unable to return to normal operations due to requirements or guidance issued by DHHS, CDC, OSHA. So again, you're continuing to pay your employees, but your state might have a lockdown where you can't resume business as normal. In that case, you can the reduction in FTE employees won't result in a reduced forgiveness amount. And also the forgiveness amount is reduced by any grant portion of the economic injury disaster loan received, as we just talked about. So if you received a $10,000 grant and from the EIDL but didn't get the loan, you only received the grant portion, and now we're applying for forgiveness, and say you received $100,000 in PPP loan funds, and for and all of that qualifies for forgiveness. The SBA will actually reduce the forgiveness amount by that $10,000 or any EIDL grant you receive. So that essentially will need to be repaid. Okay, so the forgiveness of the PPP loan is not going to be subject to federal income tax. However, that being said, the IRS issued notice 2020-32, which stated when tax exempt income is earmarked for a specific purpose, expenses incurred in carrying out that purpose will not be tax deductible. So it's clear the IRS doesn't want taxpayers having a double benefit. So you're receiving tax-free funds. Again, they generally don't allow deduction for expenses paid with those tax-free funds received. So it's been made clear that the intent of Congress when this was passed was to allow the expenses paid with the PPP funds, and the AICPA supports allowing the deductions due to this. Like they say, we understand the IRS, the Department of Treasury's position in not allowing these, not allowing the deductions paid for with these funds. However, with this unprecedented time, giving taxpayers that added benefit and keeping, if this can help keep businesses up and running during this time, we're told that there's largely bipartisan support for allowing these deductions. But again, the Department of Treasury, the IRS, their position is if that's their intent, it needs to be passed in a law. So the next, we definitely expect this, the deductibility issue to be addressed in the next round of legislation, whenever that may be. All right, now we we get into the timing of the application. An affirmative response related to the forgiveness will be given. So once you submit your documentation to the lender and is forwarded on to the SBA, you'll receive an affirmative response that as to the forgiven amount. And at this point now we're in the middle of November. Applications submitted now might not there might not be enough time to receive that affirmative response. So, again, if the response is issued after year end, what do you do? There's a few opinions on that. You can take the deduction for the expenses in 2020 and wait to see what 2021 brings if, again, legislation hasn't been passed addressing this before year end. But if that's the route you take, there would be a possible income recapture in 2021. If at the end of the day, it's not explicitly stated that expenses paid with the funds are going to be deductible. I think the conservative approach would be if there's a reasonable expectation of forgiveness, that if this issue is not addressed, then you don't take the deduction. If this isn't addressed, it's that you're going to eventually will be forgiven, then it's probably not in your best interest to take the deduction. However, that can be discussed on a case-by-case basis. I think what we'll see a lot of is delayed tax filings. Again, if this isn't addressed before year end, it may be best to not jump the gun to delay your tax filings. File for an extension and let this process play out so it's handled correctly the first time. So I think that's largely going to be our position is again, if we're not sure, we can kind of pump the brakes and wait for this to be addressed. And again, now that the election's over, we're expecting more guidance, hopefully in the near future. However, it is possible that it may be after year end for these loose ends to be tied up, if you will. All right. Also, some other issues related to the PPP loan is going to be the streamlined forgiveness, again, is expected with the next legislation. Right now, PPP loans less than $50,000 qualify for that 3508S, which is a simplified forgiveness form. There's going to be more guidance on related party transactions. If you pay rent to a related party, how is that going to be handled? It's right now it seems as though you're limited to the actual mortgage interest. If you have two related companies, same owner, one's a property holding company, the other's the operating company, and the operating company rents from the property holding company, it's still a little unclear as to how that will be handled. Again, it's not it might not necessarily be the actual rent paid, but the might be limited to the mortgage interest the monthly mortgage interest paid by the property holding company. So that's going to be something that we're going to look out for. Accounting for the PPP loan and the tax deductibility of the expenses paid with forgiven PPP funds. How is this all going to shake out? You know, there's weekly guidance issued, and we're doing our best to stay on top of everything, and so we give you the most accurate guidance available. So again, now that the election's over, hopefully we see some progress in that respect. Now, finally, we get into some tax planning opportunities. Again, we talked about the NOL carrybacks. Say you're a business and you had a net operating loss in 2018 that's been carried forward. You might have a opportunity to go back and amend your 2018 return, claim that NOL carryback so you get the benefit of the net operating loss right away instead of having to stretch that out for however many years. Charitable giving is going to be an issue. If you have extra to give this year, there's no limitation, unlimited charitable giving, not limited to a 60% of income threshold. So that might be a route to take. Again, maybe if you've been hit hard this year, if your business is really suffering from the effects of COVID, then maybe we look into a Roth IRA conversion. If your income's historically a little higher, and then now all of a sudden you find yourself in an NOL position, possibly you have a net operating loss, maybe you can convert your Roth, your traditional IRAs to Roth, to a Roth IRA, and which will allow tax-free growth and tax-free distributions. You would just have to pay the taxes on the value rolled over, which would need to be done by year end. So if this seems like an opportunity for you, I definitely suggest talking with your financial advisor, as well as getting guidance from a tax professional. And also, again, the timing of the PPP forgiveness is going to be really important. So, that being said, that's pretty much all we have for you today. Our time's running up, and again, this is a lot of information, a lot of twists and turns, and I think there's a lot of opportunity here, and if nothing else, there's a lot to know. And we just want to let you know that we're here for you. Again, this is an unprecedented time, and we need, and businesses, need to worry about operating. And if you have any questions on anything we discussed, we're here to help. So always feel free to give us a call. And again, we're happy to help you navigate this unprecedented time. So again, thank you for your time. My name is Kurt Kuchenbrod with Scott & Company, and I hope you have a great day.
Thank you so much for a great presentation, Kurt. And to our audience, thank you for attending. If you have any questions at all, please don't hesitate to reach out to Kurt or your Scott & Company advisor. We do plan on sending the presentation to you via email. And again, we encourage you to reach out to us with questions, and have a great day.
Thank you.